In this video, traders are going to look at, does it matter who owns the asset? Stay tuned. Hey traders, a warm welcome to you. So this question kind of came to my mind when I was discussing this with another trader, and I really think that it matters who holds the asset, who owns the asset you're trading. And the other trader disagreed with me, and this was kind of my argument to kind of back up my theory and listen carefully to his argument. But I wanted to share this with you guys in this video, and interested to hear what your comments are on this. So my theory was, and we're talking a little bit about Bitcoin, we're talking about some of the tech stocks, etc. And my theory was it matters because of these main 5 things. Number 1 is weak versus strong hands. So what do I mean by that? So if you look at, and this kind of plays out regularly, and it also played out a lot in crypto, you see a lot of people coming into an asset because they want to make money on the asset quickly. We see this a lot with kind of biotech shares that have news coming out. We see it a lot with kind of news-driven small caps, over-the-counter, bulletin board stocks, etc. The majority of people who are coming into that stock after the news are literally looking for a short-term gain on the stock, right? They're not looking to invest and tuck it away for 10 years, 5 years, even a year. They're looking to run it for as much as they can, make as much money as they can, and move on to the next thing. And so that creates what I believe are weak hands versus strong hands. If you compare that to, say, let's say Amazon, right? Extreme example, but let's just compare it to Amazon. So Amazon comes out, Amazon has great earnings, and if we look at it, say 10 years ago, and it has great earnings and it's starting to increase its earnings each time. The people who are investing in that stock, yes, there may well be some shorter term traders in it who are looking for quick money, but the overall volume is traded by larger funds and institutions who are playing this for a longer term trade, longer term opportunity. They're investing in this stock, in this company for the long term. So they are what I would call a strong hand. Yes, there are still going to be, like I say, traders in there who are trading in and out of it, and they're going to be some sort of action, but they're not going to be the predominant volume, so they're going to have less of an impact. So compare that biotech to Amazon. So what happens is, if you see the market running up, then generally speaking, this kind of biotech or this kind of hyped stock gets ramped up even more because the volume is really flowing into it. There's not as much volume as normal. A lot of new fresh interest comes in, and the people are weak hands because they're looking for the short-term gain. Their overall goal is to grab a quick gain and move on to the next, whereas Amazon, you won't get that. And then if you look at when the stock starts to crumble for whatever reason, then a stock like Amazon may well hold firm and not get battered as much, because whilst there will be people pulling money out, of course, there are still people who are holding for the longer term. Whereas you look at, compare it to the biotech in this example, there's no one holding it for long term. No one's interested in long term. There are very, very few people. So you're literally getting massive supply and demand swings causing the crashes. And that's kind of what happened with Bitcoin, right? Bitcoin hyped up there's a core group of people who believed in Bitcoin and believe in Bitcoin for the longer term. But there was a lot of people who came in literally who probably hadn't invested in anything before, heard of it, saw it going up for 5, 6, 7 days in a row and bought it, and their number one goal was to make money and get out of there. So of course, when the thing starts crumbling, all these people are just not even having that risk management in place, and they get out of pure panic and kind of maximum pain. So to me, it makes sense to think about who's owning the asset you're trading, because you can kind of work out what the overall goal of the majority of participants are. If it's quick money, then you know it's going to be sensitive to downturns. You can have an estimate of net worth, and this is a kind of broad thing here. I'm a bit of tongue in cheek with this, but you can say, well, actually, the average investor perhaps has got 10,000, 20,000, 30, or even as 100,000, as opposed to the average hedge fund, which may have multiple billions behind it. So you can say they're not going to be in and out, in and out, in and out. They're going to be working a position over a period of time. So estimating the kind of value of the person who's getting involved in it. And then what fuels decisions? So again, is this an investment that's a trader or an investor or hedge fund manager is making for multiple years, or is it somebody jumping on for the hype and they're going to be out when they see 10%, 20%, 50%, 100% in the move? And also, knowing that that also will affect them to the downside. And this is the key thing. This is why I believe, when I did a video about this, about the participants in Bitcoin, and we see this regularly as well with stocks that get hyped up and move, multiple hundreds of percent very, very quickly, or not a lot. We saw a little bit with the cannabis. It maybe has calmed down a little bit, but some of the cannabis stocks kind of did it. Some biotechs kind of regularly do this. You get a different type of investor slash trader in it, and their max pain level is far, far less than the bigger hedge funds. Yes, sometimes the hedge funds, we see kind of some of the tech stocks rolling back heavily and they have to pull out because they need to kind of play defensive a little bit. But we're not talking about a little trim off the top. A lot of these guys who are looking for that quick money, that quick kind of return, are very, very sensitive to adverse moves. And if it moves back slightly against them, especially if they've piled in aggressively at highs, their max pain their pain tolerance is very, very low, and they come out. So that affects how the stock trades. That affects how quick the downturns are, whether it's a pullback or whether it's a V-shaped reversal. And if you go back and look at kind of charts of Bitcoin and Tilray and some of the biotech stuff that we had a massive boom around, things when things were called blockchain, with all sorts of bits going. Lake Pharmaceuticals, another one. All these kind of stocks where you have these kind of V-shaped reversals because the participants weren't the standard investors. The majority of the participants weren't kind of longer term portfolio slash hedge fund managers or even retail investors chucking it away for a multi-year move. They're different type of players. So to me, it matters who owns the asset, and it's something to consider when you're trading it. If you're trading a small cap stock, think about who owns it. You can look on finviz.com if you're trading stocks and see institutional ownership as well, to see kind of what the majority of holdings are. Otherwise, you can just make your best assessment. You can look on forums, on social. Is it a very popular retail stock? Is it not? And that kind of stuff. And make your own judgment and say, well, actually, that means that it may well trade differently to what I expect. And so I may use different strategy, I may use different risk management, I may play it differently, in a completely different manner. All right, guys, let me thoughts on that in the comment section below. Do you agree with me? Do you think it matters who holds the asset, who owns the asset? Or do you think a chart is just a chart and what will be, will be? And whatever you're doing, guys, take care, keep mismanaged. See you next one. Bye-bye.